So guys, this is our Q3 2025 story. Let me make sure this is working, right? Well, as always, we have to do the disclaimer. So that, of course, today we want to have open, frank discussions, and of course that may lead to us making some forward-looking statements, which are statements that we truly, honestly believe to be true, based on our predictions, forecasts, and indications. But of course, ultimately, things may occur that may cause actual results to differ materially from what we're saying. But of course, at this time, it's based on your team's best estimates of what's happening in the market. Okay? All right, just to restate, always like to say this and share with you our values, our purpose to provide peace of mind and prosperity to communities in the Caribbean and across the world. Across the world right now is really the Netherlands, but we'll add to that as we go on. All right, our mission to lead the world in creating financial freedom for you in good times and in bad through positive interactions empowered by technology. And of course, for many of you here are investors, our investment proposition to sustainably compound wealth at an attractive return on capital and regularly increase dividend distributions by superior governance and capital management via our balanced and diverse business units who aim to lead the world in financial service product management and customer experience. So you see, I'm not just increasing dividends for some other reason. It's actually in the mandate, right? Okay. So guys, we run a calendar year, and this is our year-to-date, January to September 2025. So we all know the next quarter will have some other updates in it, right? Why? Because that's when the hurricane hit, right? So this is as of September, but we'll speak to Hurricane Melissa a bit as we go forward. And just to say, of course, our hearts go out to all our colleagues, friends, customers in Jamaica right now. But you know what? We're also excited because this is why we're here. This is what we do. So we're actually very, very happy that we've been able to support. And you'll hear more about that from our President of Guardian General, Dean Romani, and our President of Guardian General in Jamaica, Karen Borising. So guys, for Q3 2025, what have we done? We've delivered strong results of $1.28 billion, $1.28 billion, sorry. If it was 1.2 million, I would not be here, obviously. So $1.28 billion in profit, representing a very large increase over Q3 2024. But that includes, in this financial year, the one-off $650 million gain from Toma. So notwithstanding that gain, we would be 7% up over prior year on the continuing operations, all right? And I know Keisha will get into that a little bit, the CFO, all right? So our cost-to-income ratio, why is this important? Because we believe that revenues must grow and our cost-to-income must fall. And we always talk about that, we call that the jaws. The jaws must be opening, not closing, right? Otherwise, eventually they will overlap and you'll go into losses. So our cost-to-income ratio, we continue to work on this. I would say 3 years ago when I joined, that cost-to-income ratio, Sam, was 26%, and now we're at 20%, and we aim to get down to 17%. Our target actually is 15%, and of course, that will come in time. So we've moved from 21% last year to 20% now, which means, from an operating basis, it takes us 20 cents to make $1. That's good business, right? In terms of our operating expenses. Our equity attributable to owners of the company increased to $6.1 billion. Now, of course, we do have the retention of some of the Toma gains in there, which would have contributed to that, but that's a 43% increase over the same time last year. All right? Our dividend, we've declared a dividend of 23 cents per share, which is our third dividend for the year, and that would bring our total dividends that we've declared for the first 3 quarters to 66 cents. Which of course is a significant increase over prior year, but prior year we would have had 1 interim dividend. So I know it looks really good, 180, and that's for the headline newspaper, right? But of course, it's because we're paying dividends more frequently, but we do intend to increase dividends. Just don't expect an overall year-on-year of 187%, just managing expectations. But as of the interim dividends, we paid 3 this year, whereas we only paid 1 last year, which is why you'd have that, but we'll take the 187% headline, all right? So, of course, this past quarter, in quarter 3, we would have also announced the acquisition by Guardian Life Limited of NCBIA, National Commercial Bank Investment Advisor, pension fund business in Jamaica. And that is a big deal. So in Jamaica, we had about 6% of the market share for the pension administration business as Guardian. NCBIA had about 18% of the market, right? This is not a big focus for that institution. It is a big focus for us. So we took the opportunity to make them an offer and negotiate a deal. So by buying their market share, as of now, we would have roughly 25% or a quarter of pension assets in Jamaica, which is now a springboard. Of course, this is a scale business, and this business is a natural fit for us because it's long-term management, but it's also a great complement for us because our other large businesses, life, health and pensions, etc., there's a lot of volatility. Claims can change, interest rates can move. Pension fund administration business is set it and forget it business. You charge a fee and you manage the services. So it's more predictable income. So it's a great complement to our more volatile investment-based income. So as a former banker, I would say, for example, you have your loan business, which you can have good loans, bad loans, but you know where you make your money? Those transaction service fees, right? So this is our version of that, the pension administration business, for those who are the bankers in the room. So of course, we've maintained strong credit ratings, and we've maintained our carry AA minus rating on the regional scale, and our AAA Jamaica rating on the Jamaican national scale. Okay? So I know my colleagues will give you a little bit more about the actual insurance part, settlements and so on of the situation in Jamaica, but I just want to let you know that we are actively involved, not just as an insurer, but as a community partner in Jamaica. So of course we made donations. It's 312,000 US. I like to say Jamaican 50 million because it sounds a lot bigger. Same amount. Of course, we're giving our employees support across all of their needs, all of our staff there, because they have to be good in order to provide the service, right? We've also established a 500,000 Guardian Group Jamaica Employee Relief Fund exclusively for our staff to help them. Some of our staff were living on their cars and stuff like that, so we have to get them the support. And of course, we've done care packages, and we also partnered with NCB, our parent company, to provide recovery loan facilities so that they can actually, get more funds to help rebuild, and of course, counseling and services for those who've been impacted. But my colleagues will give you a bit more on what we're doing. So of course, we have a discipline strategy. And guys, we spend 2 days off-site every year refreshing that strategy. And our strategy is based on the 3 Horizons strategy. I know I say it at every meeting, but you'll bear with me. Because you're always in Horizon 1. You're always trying to protect and perfect your core. That's your systems, that's your underwriting performance, that's your cost efficiency. That's the key things that make you operationally resilient. Horizon 2, right, which is our kind of 3-year outlook, which is growing the existing business, which of course through customer segment expansion, acquiring portfolios, acquiring companies that fit, stronger distribution, looking at our network, our business, the sales business, and of course, in this horizon, continued opportunities to invest in technology and so on to build our operational efficiency and drive profitable scale. It's not about reducing staff, it's about allowing staff to do more value-added activity while we introduce things like AI and other things into our technology. Because AI is a great opportunity, for example, in the underwriting field and otherwise. And of course, Horizon 3, which is where I like to spend most of my time if I could, which is really attack mode. Always looking at how do we deploy capital selectively to get greater market expansion, to get into complementary adjacencies. So for example, the bigger push into pensions and growing the services around that touches on Horizon 3. It's an existing business, but we were so small in that business, you really had to move into attack mode to get any type of scale so that you use your capital most efficiently, right? And of course, looking at that inorganic strategy to unlock new earning streams. So we're looking, for example, not all markets, for example, in our business allow an insurance company to go into brokerage. We can't in Trinidad and Tobago or in Barbados, but we can in Dutch Caribbean. So we actually own a brokerage in Dutch Caribbean, and I'm sure you'll hear more about it, Bogart. So in certain markets, we're going to be picking and choosing what we do, right? So while the horizons define our strategic pace, these themes are also, and let's give a little more detail, and it's color-coded. So you'll see the, I went back. So the blue, the yellow, and the, what color is that, brown? Magenta, thank you. In case you all don't know, I'm somewhat colorblind, or that's what I claim every time I choose a tie at home, and my wife doesn't like it. So number one, which is part of protecting and preserving the core, strengthen our earnings quality. So this is to ensure that the core engines of our growth, of our earnings, are preserved and functioning well. So it's underwriting discipline, claims efficiency, and service reliability. The things you have to get right every time. There's no margin of error for it. In banks, it's the ABM uptime, right? That has to be 99.999%, right? Oh, where's Karen guiding? I saw her. Karen, where are you? Right. Or the uptimes of the ABMs at Unit Trust as well, right? Scale profitable growth in existing markets. So, of course, deepen penetration in focused segments and channels, which is, of course, our sales force, and making sure that every single customer who needs our services, we can find them, we know where they are, and we can reach out to them. Accelerate digital data, AI-enabled operations. I'll leave a little bit for Greer to talk about that, but we have to make sure that we are operating most efficiently and accurately. We have data protection legislation and so on now, and the best way to get these things done is to embrace technology and ensure that we are leveraging all of that. We have our product factory as well, which is where we leverage our big data, our data analytics, to feed our business units the right information at the right time so that they can execute on their strategies. So this is all about building capability, strength, and efficiencies, right? And of course, doing it right. Optimizing capital and strengthening our balance sheet. And you'll hear a little bit more about that from me and as well from Rob Chen. And of course, position ourselves for strategic expansion and adjacencies. And that's what we talk about, for example, the pension plans, the brokerages, and other businesses that we're exploring across the region. For example, I'm not saying we're going to do this one, but for example, we know of success stories of property and casualty insurance companies that actually own all of their own garages. So they are now vertically integrating there to manage costs of repairs and so on. Or insurance companies owning health centers to manage the rising cost of health insurance, right? So those are things that we can all look at. I want to touch a bit on that optimizing capital, and one critical element of capital, Mogliani and Miller, right? Debt management, and that's very critical for us. So of course, as some of you would know, we would have had a maturing bond. It would have been maturing in December of this year. And we decided, listen, let's move ahead. We know what's coming down the line, more and more government borrowing and so on. Let's refinance our structure early. We chose to keep our TTR liabilities, and we are actually paying down some of our other liabilities in Jamaica, etc., to manage our overall interest costs. So we pay now, of course, you pay down your highest cost debt, and you keep in markets where you think you get a reasonable debt. So we would have refinanced our $1.02 billion bond on September the 9th. So kudos to the team. And we also did something else. Instead of leaving it at a set 5-year, 10-year maturity, we created a laddered tranche system, so 3, 6, and 10 years, so that we don't have $1 billion maturing at one point in time going forward in the future to give us a much more predictable and stable long-term capital base. So we're also deleveraging. So we've made 4 consecutive quarters of principal repayments, reducing our borrowings by $276 million over the last 12 months, and including just last month in September, we'd have paid off our $2 billion, roughly, 84 million TT in Jamaica debt. We also have another 1.8 billion, which is 76 million TT dollars, to be repaid over end of this year into 2026. So we'll continue to bring down our debt, which means, actually, I think when I joined, we were just about over 100% debt to equity, and we are now down to 56. It's there, 56%. Right, 17. Okay, it's on the chart. That's why you must read your presentations before you give it. Thank you very much. Right. Yes. Guys, I just came from another investor briefing. So NCB did their investor briefing this morning, for those of you who were on, and I had to memorize all my stuff in Jamaican dollars, okay? So bear with me. All right. Okay, so of course, my last slide for this part of the presentation is to talk a bit about our dividend strategy. Kind of saying it a little bit earlier. So of course, we are now doing quarterly dividends, so you'll see more frequent interim dividends. And that we also we wanted to do this when we were fairly confident that we can sustain it, that we can, generate the cash flow and make sure that, as a long-term capital investment business. A lot of our gains and losses come from movements in the markets on the investment side, which is not necessarily cash generating, right? It's fair market movements for the future because we run 30, 40, 50-year long-term liabilities. So we can't just have everything maturing today, right? Because we have to create value for our policyholders in the long term. So that's the balancing act that we do, and that's what you're seeing. And I'll give Don Christian and Keisha and the team credit for this, for managing this so you can have a predictable interim dividend flow. And of course, after Q4, which ends in December, we'll be announcing our full final year dividend, right? So what we've been trying to do is keep that going, and you'll see more about that coming in the future. So, of course, we are at 66 cents for the year so far, and a better comparative will be this time next year when you have 2 years of quarterly dividend payments.